All right, everybody. Welcome to the cryptocurrency fundamental analysis course by Watch to Earn, and welcome to lesson one, which is what is cryptocurrency. So, here's the table of contents for you guys for today's video. And at the very bottom here, you'll see new terms and concepts. That basically just means we're going to go over all the different terms that we learned in today's lesson, and then also the different concepts. So you guys have like a little summary at the end. So for your own comprehension checks, or if you want to do anything like that, or take notes, etc. So let's get into it. So 1.0, welcome to the course. Welcome to Watch to Earn's Crypto Fundamental Analysis course. This course is designed for people who are interested in cryptocurrency but aren't sure how to go about it in a more sophisticated manner than just by watching YouTube videos or by finding what's trending on social media. This course will be 12 lessons long and 100% free on YouTube. If it's possible, donating will be greatly appreciated. We are accepting donations in Ethereum, BNB, and our own token Watch to Earn, or W2E, at the following contract address. So here's the course wallets here, and then you can scan this on your own, or this will also be in the description. So you can send all the tokens here, and then our Watch to Earn token will be in the description box. So I'm using this course to partially upsell an upcoming website called Trade Token Markets, where there will be extensive data-driven insights on cryptocurrency prices to help cryptocurrency traders. So if you decide to donate via purchasing our Watch to Earn token and keeping it, you'll have early exposure to the token that'll be used for payments on the website. And Watch to Earn contract address can be found in the description box, as I mentioned before. So here are the upcoming lessons within the course. So it's going to be a total of 12, but here are lessons 2 through 7. So lesson 1.1, what is cryptocurrency? So the official definition on the internet is cryptocurrency, a digital currency in which transactions are verified and records maintained by a decentralized system using cryptography rather than by a centralized authority. Whereas my personal definition is cryptocurrency, a digital medium of currency that allows for the unprecedented ability to privatize money. This also allows for a more robust and personalized global economic system where people aren't at the mercy of centrally managed economies like we are today through limited fiat currencies and government control over said fiat. And basically meaning centrally managed, where that can literally mean like in a communist style like North Korea, or in a more abstract sense where even though yes, in a business world, we're able to have free markets, in most Western or developed countries, the central bank typically has pretty much complete say over interest rates, and sometimes the executive branch also has say over financial matters such as addressing or giving stimulus checks, sending financial aid, etc. We don't have a democratic process for that. So in that way, I can say it's more still centrally managed style of economics, if you kind of want to think a little loosely there. So lesson 1.2, brief history of crypto. So the very first cryptocurrency was Bitcoin, and its ticker symbol is BTC, and some people just refer to it as BTC, and you'll hear me say that probably. That debuted in January 2009 with a starting price quoted at around the 0.0008 mark, doing 100x in its first month to 8 cents per Bitcoin. It was created by an anonymous man group called Satoshi Nakamoto, typically referred to as a man though, or as a guy, whatever. The 9-page Bitcoin white paper, which is a document that details the specifics of a coin or crypto project, refers to the cryptocurrency as a peer-to-peer electronic cash system. So instead of the terms gold 2.0, store of value, and digital gold, those type of labels that Bitcoin often gets, the official white paper describes the coin more as a generic blockchain-based payment system similar to Cash App or PayPal. So even though it doesn't use the exact analogies of Cash App or PayPal, the tone of which is more so like that. It's more so generic than how sometimes typically is marketed by Bitcoin enthusiasts, maximalists, etc. So, although briefly stated, the main focus of the white paper is to highlight how internet-based commerce can now be done in a trustless manner instead of traditionally through third parties. And the definition of trustless is the ability to rely on cryptographic proof instead of human third parties for transactional settlements and legitimacy. So, Western bias, and this is coming from the perspective of Americans, so if you're from anywhere else outside the world, just fix this to where you're at. but Western bias may overassume the availability and quality of international financial services. In July 2022, the World Bank estimated that 1.4 billion people globally, which is about 17.5% of the Earth's population, were unbanked. And these are typically, religious minorities, women, people in like war-torn areas, etc., like that. And simultaneously, we can assume that there are at least another 1 billion people, and this is just a loose figure. But I said if there's 1.4 billion people unbanked, I can assume there's at least 1 billion more who have at least subpar services. And those subpar services, financially speaking, are typically heavily influenced by either an inefficient financial system or government, or also by a overreaching government, such as Nigeria, which is going to be the example of this video. So, using our rough, 2.4 billion figure, this accounts for 30% of the human population, where if you line up the countries sequentially by human population, due to the skewed population demographics of certain countries, such as China, India, and the US, this easily represents 60-70% plus of countries, if you want to look at it that way. So, so crypto essentially just has a very large target audience to address, and we barely scratched the surface in terms of pure, or true crypto adoption. Let's say. So, the beauty of a trustless blockchain is that it dramatically democratizes the financial environment. It empowers the everyday person to self-administer financial services with little to no fees and also near-instant settlements. This allows people in the Western world to gain financial sovereignty from their national governments, and people in the developing world to finally get access to quality financial services. So, obviously, they can be interchanged, but these are just the 2 points that I've noticed between the 2 different landscapes, I guess. So, Nigeria is one of the top countries for real-life crypto usage, and as of recent, there was a Nigerian Bitcoin premium of 60%, meaning that the Bitcoin Nigerian market pushed Bitcoin up 60% higher than Bitcoin's price in the rest of the global markets. And this is the reason is because in January 2023, the Nigerian government announced that it would max out citizen cash withdrawals only $44 per day in their country's currency called the Naira, in efforts to boost usage of the Nigerian CBDC, which is a central bank digital currency. And we're going to get to that later on in this video. So the question is, why should a government be allowed to control withdrawals over its own citizens? And that's essentially the whole point, where cryptocurrency, because it's decentrally, it exists in a decentralized manner, meaning that no one person, no one party is able to censor it, shut it off, theoretically it would not. Because of that, it's very hard to take away that incentive, especially when a government, I was going to say a random government, but not random, but when a government randomly imposes such laws, for example, literally just withdrawing, limiting cash withdrawals for the sake of forcing people to put money into their central bank digital currency. It's that tyrannical power that the governments have over citizens, whether or not they decide to use it, it's disadvantageous to the general public. And so if you have another means of operating financially, especially in in countries such as Nigeria or Argentina or Venezuela or possibly Ukraine today, etc., like that, cryptocurrency seems to be an extremely viable alternative to the traditional fiat system. So, next slide. And in the same way, the United States believes in arming its citizens, and in this case with firearms, to prevent government tyranny. I believe crypto gives the same power, or gives the regular citizen of any country the same power, but just in a financial sense, as I was kind of referring to with Nigeria there. So without the same financial dominance over its citizens possible with the fiat paradigm, crypto stands to liberate the world in orders of magnitude more than the internet did with information, and amazing times we live in. So, so cryptocurrency is often referred to as Web 3, so the third wave of the internet. So yes, technically cryptocurrency is still the internet, but obviously you can understand that, before the internet existed, and especially during the days of World War I, World War II, the power the government had over the citizens due to the lack of information that the people had, either just through domestic issues or also through international means, versus today where we can get news from around the world pretty much instantaneously. The power of the government over its citizens in terms of information has greatly diminished. So in the same way that happened due to the internet with information, cryptocurrency stands to liberate the world immensely, but in a similar fashion, just financially speaking. And in my opinion, financially, the financial liberation should be more strong than the informational liberation, because at least with cryptocurrency, at least you're able to actually do something about your economic situation. Whereas the internet is good, but it on its own you can't really do all too much. You know what I mean? So that's at least my opinion. Lesson 1.3: different crypto sectors. Within the 14 years of crypto, different sectors and in traditional finances would be considered asset classes have emerged that serve different use cases and markets. The most common crypto sectors are fungible tokens, non-fungible tokens or NFTs, decentralized finance or DeFi, decentralized autonomous organizations or DAOs. So fungible tokens are the standard cryptocurrency that you're used to. So those are the Bitcoins, Ethereums, BNBs, etc. These tokens are defined by the fact that they are interchangeable with any other token in its economy. So for example, if the number 12 minted BNB is worth $300 today, you'd be able to go to any crypto exchange and get exactly $300 for it in any other cryptocurrency. And if you exchange the number 12 minted BNB for the number 1000 minted BNB, they have the equivalent value 100% of the time. No, zero exceptions to that. Where non-fungible tokens, NFTs, these were popularized with the Ethereum blockchain in the 2017 and 2021 crypto bull runs, but its origins are stated to be from colored coins from the Bitcoin blockchain all the way back in 2012, which isn't even widely known even within the crypto industry. So, but today, color coins are pretty much phased out. Today is just NFTs, typically on the ERC standard on Ethereum, but there's multiple different blockchains that host NFTs nowadays. NFTs are the opposite of fungible tokens. These tokens are individually unique from one another, even if they are identical in visual appearance, or visual appearance, yes. So an analogy is an original and copy birth certificate. These could be the exact same image with the exact same person's name on it, time, parents, signature, whatever, but they are two individual documents that have different attributes associated with them, such as the print time between each document, the print location, the purpose, the total quantity, the value, etc. And so in this case, the original and copy would be two individual NFTs, where these wouldn't be interchangeable like how we just mentioned with the fungible token example before. So while NFTs are mainly just known for being digital collectibles and a part of some indie blockchain-based games, they hold enormous future potential, such as in the case of soul-bound or non-transferable NFTs. These are NFTs that are attached to a singular wallet that can't be transferred out of said wallet. The most popular use case so far is for blockchain-based IDs. So if a blockchain ID is issued, as long as the person has it present and the person is on the ID, so meaning that as they're presenting the ID to go into whatever establishment, they're the exact same person on the ID, there will never be concern of it being a fake, because we could trustlessly look up on the blockchain who issued the NFT, which most likely would be the local or state government. And so if you see on the right here, if you want to look more into this, you'll look up South Korea looking up to launch digital IDs on the blockchain. So this was, I think more than likely in 2022, a few months ago now. I'm not sure what time that was, but yeah, that's something you can look into. So NFTs, yes, they are mainly just known for the profile pics and whatnot currently, but the NFT infrastructure is developing in terms of how to best incorporate them within crypto projects and also just in the real world. So they're growing, and they're much more than just little images then. So decentralized finance, DeFi, is a crypto sector that focuses on financial products and services that exist on a decentralized platform. DeFi products typically offer incentives such as no KYC or AML and no/extremely limited geographic censorship. And the reason why that's an asterisk is that some DeFi projects have have banned countries due to international sanctions, but typically this can be resolved with VPNs or other such technology. So yes, that's why it's in theory decentralized. Anything decentralized is supposed to exist on what's it called? It's supposed to exist on the blockchain, and that's supposed to be available for everyone globally. But the reality is that because the internet is needed for blockchain access, people can still be geographically censored. And so a few years ago, there was pressures, for DeFi projects, allowing access for countries such as Iran, such as North Korea, such as countries like that. So those type of countries are typically banned or censored. But even in certain even certain crypto casinos, the United States geography is typically banned, but typically VPNs can overcome this though. So KYC and AML, or Know Your Customer Anti-Money Laundering, is a process, procedure, or system of governmental regulation of financial services. This process aids governments in their fights against money laundering and terrorism funding, which are typically the two main ones. But just basically any illicit crimes involving money and finances and whatnot. So, while their missions may be just, some argue that the government's ability to look into, seize, or suspend any person's fiat holdings in the sake of protecting the public is a breach of financial privacy. Such concepts of financial rights, similar to the right of free speech in the United States, are common in Switzerland, as I looked up recently, whereas in places such as the United States, that's virtually unheard of. So, just basically meaning that, if you're looking to protect the public from, money laundering, realistically, why are you doing it at the $10,000 level? If we're talking about cartels, if we're talking these type of people, these people deal with, 9, 10, 11 digits worth of money. Why is, a $5,000 deposit here, then a $10,000 deposit here automatically, setting off alarm bells for people, essentially. So it's, yet again, when you give the government power to do something, they will do it. Not saying that they're not doing their jobs and trying to track these people down, but they easily have the means of abusing it. And so that's what kind of DeFi tries to go against. So DeFi benefits from no KYC and AML because it allows people to trade, invest, transfer funds, provide liquidity, etc. without the oversight of any regulatory body and without having to trust a third party with valuable personal information. And because of this natural anti-government stance, DeFi projects have faced their fair share of scrutiny in the past few years, both from regulators and then also just from crypto skeptics, basically saying that, crypto is made for criminals, all that type of stuff, and DeFi just aids that. So that's kind of the push against DeFi in the general media. So common DeFi crypto projects include decentralized exchanges, or referred to as DEXs, where users can exchange currencies with no KYC or AML. The two most popular DEXs are Uniswap on Ethereum, which is the one on the bottom, and PancakeSwap on Binance Smart Chain, or BSC, respectively, and PancakeSwap being on the top. DEXs are valuable because people can exchange larger sums of money, 4 to 7 digits plus, in an instant without triggering any money laundering concerns due to the $10,000 transfer law in the United States. So whether that be that for the United States or any other similar law or procedure, there's a certain threshold where moving X amount of money will trigger notices from banks, or you might have to sign this, or you might be asked that, whatever. It's a way to avoid all that, essentially. So crypto users provide liquidity to these DEXs as well. So when others want to exchange their crypto, there's more money in the pool to do so smoothly and without causing too much, it's called price impact, or changes in the price. So in exchange, they receive a small portion of the fees generated from trading activity. So it's financially beneficial to do so. So especially if you get into a DEX liquidity pool when the coin is early, such as for Wash to Earn, for example, if the token appreciates greatly, you stand to make a lot based from the money that you have in the liquidity pool, and then also what you make in terms of trading fees, because the trading fees are going to be based in the actual token itself that you're supplying liquidity in. So decentralized autonomous organizations, or DAOs, are digital organizations that are generally held together by a series of smart contracts where people around the world are able to become members by purchasing the DAO's token and then vote on proposals that can make real world impacts. So, an asterisk, the DAO sector is sometimes referred to as the governance sector or just governance. So you'll hear those interchangeably. The most recent notable DAO news, in my opinion, was the Uniswap DAO deciding to launch version 3 of the DEX on Binance Smart Chain as opposed to just on Ethereum, which Uniswap is natively on Ethereum and not Binance Smart Chain. But so that is very big news anyway. So the DAO sector gets the least coverage, so it's not as sexy as NFTs or fungible tokens, whatever, or DeFi. But in my opinion, it has the same, if not larger, potential than DeFi. So lesson 1.4, different crypto tokens. So alongside the different crypto sectors, there are also different types of crypto tokens that serve different purposes. Some of these include privacy coins, such as Monero, you see here on the bottom, governance tokens, stable coins, and within stable coins, there are different types of stable coins. There are algorithmic, fully collateralized, pegged, so kind of like wraps, like the Binance Peg stable coins, for example, if you know what that is. Wrap tokens, utility tokens. The term utility tokens is semi-phased out. This was kind of to be in contrast with Bitcoin, where Bitcoin was said to just be a store of value token, where utility was more so like you're able to actually do something, such as Ethereum. But now that a lot of tokens have introduced smart contract and it has introduced smart contract enabled smart contract abilities or capabilities within their blockchains or their cryptocurrencies, a lot of tokens automatically fall under the utility tokens category. So that terminology is kind of semi-phased out here. But there's LP tokens. So LP tokens are tokens that are, when you provide liquidity into the DEX, so I just explained to you, you get these LP tokens, which are essentially like receipts, essentially. And there's central bank digital currencies such as the e-Naira for Nigeria that we're still going to talk about soon, that we're going to talk about a little bit more actually at the central bank digital currencies. And then there's also fan tokens, for example. So these are just some of the ones that are mainstream. There's probably even more. These are the ones I could just think of at the top of my head. But at the bottom here, you can see the ones that I personally made up, which is the corporate token, which is what Watch and Earn is, the crypto subsidy, which I've yet to explain, eco token, inflationary token. All three I've yet to announce personally on this channel, but I've had these for some time now. And there's one more, which I mentioned in a previous video, but I want to still kind of keep that in the tuck until I get the financial capital to act on it. But yeah, so you'll see that sorry, I forgot that I wrote that right here. So next slide here. As time moves on, there will be more and more use cases for cryptocurrency, and thus there will be even more categories of crypto to come, making this list that I just showed you antiquated probably in the next 3 to 5 years, most likely. And because of this, it's extremely unlikely, in my opinion, that any individual or group of government powers could realistically enforce industry-wide regulation, as the speed of bureaucracy doesn't hold a candle to the speed of industry growth and innovation, no matter what officials say in the media. As time goes on, you'll grow accustomed to the different types of crypto tokens, which will allow you to discern between projects when conducting analysis. So currently, which is March 2nd, 2023, there's a lot of hoopla, as you remember from the SpongeBob episode, that essentially every single coin is a security, no matter what it is. If it's not Bitcoin, it's a security, and the whole point is that, you know, if we're arguing what a security is, all right, cool. But they're arguing if the stablecoin BUSD is a security or not. I think Ethereum as well, which is a staking token or a staking coin, they're trying to consider it. So by the time they figure that out, you know, when are they going to issue legislation on the wrap tokens? Then what about privacy? What about LPs? What about fan tokens? What about my stuff? What about all the other ones? So it's like it's going to take forever, and the reality is that governments who embrace crypto are more than likely going to win in the long run versus the ones who are trying to prohibit it, in my opinion. And not just my opinion, also it's just the overall crypto industry's opinion. So yes, lesson 1.5, traditional crypto versus CBDCs, or central bank digital currencies. So central bank digital currencies, CBDCs, are government issued blockchain based cryptocurrencies. Despite being blockchain based, since governments would exclusively designate the validators of the blockchains, there's possibility for complete government control over the financial system. So
this is a key point here to bring up, that blockchain and cryptocurrency are two separate fields technically, where cryptocurrency falls underneath blockchain, where the blockchain, allows you to do, permanent stuff within the internet, while cryptocurrency refers to the actual financial part of it. So the CBDCs, or sorry, so before I get to that part, this course will be talking about cryptocurrencies. So if you don't know what blockchains are and blockchain technology is, I'm not going to go into that into this in this program or this lesson, but that's something that you should look up briefly, after this video, or pause this and come back to it. But yeah, if you know how blockchains work with validators, you would understand that blockchain projects or crypto projects designate who their validators are based on however they want to come up with consensus for transactions. And because of that, the government would most likely either just appoint other government bodies to be the other nodes, or very looped in commercial banks. Essentially, those are the other entities that I've seen. So people who aren't aware might see the statement of complete government control over the financial system as an over an exaggeration, but this is extremely very literal, literally. CBDCs allow for automatic, systematic tracking, freezing, limiting, and seizing of assets solely at the discretion of the blockchain validators. So excluding the potential for literal biblical levels of tyranny, such as in Revelations, what's it called? What was it called? The Antichrist and stuff like that. Yeah, literally stuff like that. CBDCs fail to accomplish a major element of traditional crypto, which is that CBDC monetary policy is dictated by the exact same people who mismanage the fiat version of the CBDC. So that just means that citizens give up even more financial privacy for the same levels of inflation and mismanagement. So yeah, which is where part of the allure of going to Bitcoin or going to Ethereum, BNB, whatever token you want to go into, is that not just also because they are, independent of any, national government, but also just because they have different monetary policies than what's available in fiat. Whereas if the government is taking, the United States dollar and making it a blockchain-based United States dollar, why would they ever change the monetary policy from fiat to the crypto base or the CBDC? Because that means that they're changing the monetary policy. Those are two separate different currencies. They're not the same. And then we're going to question, then why wouldn't they just do that already in fiat? So many different questions. So the whole point is that if they're trying to introduce a blockchain-based version where you can permanently lock people out, instead of now where you have to kind of go through a procedure through commercial banks, or even if you hold cash, for example, they literally can't do it. If you're trying to enforce the CBDC version of that, what is the incentive in terms of the population to give up control over their own cryptocurrency and or over their own finances for the sake of just having a cryptocurrency version of their fiat? That makes zero sense. So that's a proposition. It makes zero sense, but that's literally what governments are trying to do, and it's really in efforts to trying to combat the power of crypto, because people they understand the threat that fiat is facing against cryptocurrency, but the CBDC essentially it's a useless cause. But it's very important to understand this, because this is going to come up very soon. It's already coming up in the news, but it's going to be more so in the next coming few years. And as that comes up, and as I'll cover a little bit later in the presentation, as CBDCs arise, you can definitely expect more crypto usage to arise too, which affects your analysis points and your investment strategies within cryptocurrency if you're looking to do so. So we mentioned Nigeria earlier in lesson 1.2. The Nigerian government wanted to limit cash withdrawals, and that's against the will of the people, to boost usage of their e-Naira CBDC. If the government is willing to limit cash withdrawals suddenly, what faces there is that they won't overstep their power again in 5, 10, 30 years' time. As the e-Naira failed or fails to pick up adoption, but still continues to get pushed on the citizens, even more traditional fiat adoption will be the byproduct of that. And at the time of writing, Nigeria is towards the top of nearly all top crypto adoption lists. So although CBDCs are being developed and are beginning to be deployed, one of the greatest catalysts for crypto adoption will be any large-scale or global agenda to convert the average person to using CBDCs. So when you look at the top crypto adoption list on Google, if you just Google that, you'll see typically, um, you'll see typically, I mean, Nigeria, you'll see Argentina, you'll see Venezuela typically, and it's such countries that are in economic turmoil essentially. So, in the Western world, the critique against cryptocurrency is that it doesn't have any real use cases. But the reality is that even though we have our Joe Biden printing trillions, like Oprah, you get a trillion, you get a trillion, we all get a trillion, doing all that and messing up our stuff. It's not the exact same, obviously, as other countries in terms of their brutality and their government tyranny in terms of the financial system. So when you see countries like that, or who are in economic turmoil or in economic distress, the central bank, or sorry, the crypto industry and the crypto real world usage has actually proliferated, and not just recently, but actually for the last few years since being in crypto. I've been in crypto since May of 2020, so it's coming up 3 years for me. But yeah, I've always heard people in these type of countries using it, and it's just more and more so now. Lesson 1.6: Crypto versus stocks. So, a concept that's confusing to beginners is the difference between stocks and crypto. Simply put, stocks measure the value of equity or ownership in a particular public company, primarily due to past, current, and prospective business performance, but it could be other reasons too, such as the overall economic environments, etc. Cryptocurrencies, on the other hand, measure the value of a currency within a particular economy. So these are two slightly different nuances here. So somewhat similar, but they are definitely apples and oranges. While stocks structurally must be associated with a product or service that derives from the company and gets sold to customers, a cryptocurrency is solely associated with token usage in terms of how it derives value, essentially. So because cryptocurrencies, or because cryptos only require token usage to gain monetary value, this is partially why crypto is more volatile than stocks, because token usage can vary by 1,000% overnight, and then minus 99% the following day, technically. And it just depends, what the cryptocurrency is used for, what marketing it has, etc. A few different reasons, but realistically, it can do those type of ranges. Whereas with a stock, sales, profits, revenues, etc., can't increase or decrease in the same fashion. It's going to be a far more gradual progression, and hence why the returns reflect that in respective asset classes. So another reason why cryptocurrencies are more volatile than stocks is because stocks debut on the markets at a later stage in their life cycle than cryptocurrencies. So in my model, which I call the price cycle or the price life cycle, all assets have a birth price, apex price, and a death price. These represent the theoretical price points of assets, in this case, obviously crypto and stocks. When companies go public, they are typically years away from the initial conception of the organization, meaning that the asset growth potential was typically only available to founders and early investors. Hence, after they IPO, which requires typically meeting extremely stringent criteria from the top exchanges, typically the New York Stock Exchange, the NASDAQ, or it could be the London Stock Exchange, it could be in Tokyo, whatever. But wherever they are, they typically have to have a whole bunch of stringent criteria, such as minimum revenue, minimum amount of customers, or something along those lines. So basically this means that a lot of the initial growth that you see on the little image before has already occurred, and it's not possible for the public to experience in either the bullish or positive or bearish negative direction. So on the other hand, because cryptocurrencies can be placed on DEXs immediately after being minted, or decentralized exchanges, then they're also able to be traded immediately after that to establish asset price and value. They naturally have greater appreciation potential. I have to edit that after that, but yeah, they naturally have greater appreciation potential. So if you just look at this image, you can naturally tell that the greatest potential for growth is obviously going to be on the bottom. And so because cryptocurrency is just code, and it's not a particular stock that has to be issued by the New York Stock Exchange or any of these bigwig places that require a whole bunch of fees, lawyers, paperwork, all that type of stuff, because of that, cryptocurrencies structurally, naturally have a higher likelihood of bringing those wild returns that you see on the news in cryptocurrency, where one person has like $1,000 of Shiba Inu and all of a sudden it's worth $10 million or something like that. That's only possible within crypto due to this model, in my opinion, not because cryptos are somehow well, in my opinion, they are superior assets, but it's not due to magic. It's just due to how they're set up as particular assets. So Bitcoin debuted at 0.008 and has a current all-time high of $69,045 according to CoinGecko. When you do the math, that's an 86.3 million fold multiple only done within 13 within its 13 or 14 year history. Because cryptos start earlier on their price cycles, these assets are much more egalitarian, in my opinion, than stocks because only retail investors typically go after smaller assets. So if the assets turn out to be majorly successful, a small 3-digit bankroll could realistically turn into 7 to 10 digits worth of wealth. Or, you really see 10 digits is really the highest, but realistically, for 3 digits can turn into 5 to 10, and literally tomorrow or next month, next year, in the next 2 years. Whereas with stocks, that's not really going to happen unless you just hit it big. And definitely, if they hit it big, it's only going to happen, 1, 2, 3 times compared to cryptocurrency, where that could happen with pretty much any token, if the project is sound enough. So even though that's the case, on the flip side, people ought to be greatly concerned with how price develops per cryptocurrency, why the general public is interested in said token. So, for example, the reason why I'm not a fan of Bitcoin is because future growth relies on crypto OGs, and call them crypto OGs, that's the industry, that's colloquial term, but crypto OGs are just people who are early into cryptocurrency, which are typically just early Bitcoin miners or very early cryptocurrency enthusiasts from 2010, 11, 12, those type of years. So it relies on these people to not sell their Bitcoin, which is potentially literally at millions of % discount. Some of these people got Bitcoin at $50, $100 worth of or per Bitcoin, when people come into the token and further push up price and gains. So that just basically means that as people are shooting for Bitcoin to all-time highs or to 100,000, 250,000, you have to understand that the only reason why it's able to go up there is because people who got it at $1, $5, $10, who are still holding it today, or $100, $1,000, $5,000, whatever you want to do it, or whatever price you want to have it at, is because they're not selling. But the whole point is that if the appreciation is literally, tens of millions of fold, at what point in time do you think these people are going to sell, or think that there's not going to be as much gains, or might want to cash out of their position and enter in more attractive or more higher returning assets, such as, in my opinion, BNB, Ethereum, Matic, etc. So that's kind of my point. So I think that because of that, how you say, because of that mechanism within Bitcoin, that the use case or the primary motivation for price appreciation is really the speculation. There will be an apex point in which the general Bitcoin community won't see that there's going to be any more reasonable appreciation within the coin. So, according to the price cycle and basic physics, you know that the growth rate of an asset will be the slowest higher up to the asset apex price than when it's closer to the birth price. If the saying is buy low, sell high, and Bitcoin is currently at $23,281 at the time of writing, which is currently a 29.1 million fold premium from birth price, you'd have to ask how many more millions, in terms of percent, can Bitcoin go before retracing back. And just as an example, an $800 Bitcoin, which right now seems impossible to ever happen, is still a 1 million fold premium from birth price. So, in the case of an extreme Bitcoin bear market for, extended 3 years, 5 years, 7 years, whatever, if it ever were to go down to $800 per Bitcoin, it's still 1 million fold premium from 0.008 originally. Knowing this now, you understand why new crypto projects tend to always get funding, because there's not much room to fall if you're starting from the ground floor, and the potential upside is potentially millions of percent. And yeah, so that's why you get a whole bunch of, they're called quote unquote shit coins, but shit coins are just early startup coins such as Watch to Earn. The reason why these are better investments than, let's say, penny stocks, which are considered the equivalent in the stock world, is because cryptocurrency is based on its usage. So right now, Watch to Earn only has 20-ish holders within its economy, but when it has 200, 1,000 um, 200 or 1,000 token holders eventually, the price of it will increase, and especially how it's set up with the corporate token. Whereas with a penny stock is typically with stocks that have useless inventory, useless products, or they're just not good at management, or they don't have good sales, something like that. So the likelihood of investing into a penny stock and that going up, to make you millions of dollars is going to be far less in your favor than investing into a lower cap or indie cryptocurrency project. Novice investors look at the most established cryptocurrencies for safeties with the same mindset that they do with stocks. They don't realize that if an asset can do tens of millions of percents upwards, 85% to 98%, realistically, sometimes with cryptocurrencies, like 99.9 or 99.5% drop is more than possible. And just because you just have to do the math on that. Hence, cryptocurrency structurally favors new projects and retail investors. And in my opinion, this is absolutely great and one of the main reasons why I'm pursuing crypto-related ventures for my professional career. So I'm really dedicating my entire professional career to cryptocurrency-related stuff. So I believe truly, I need to fix that too. I truly believe that cryptocurrency is the way how global poverty gets eradicated and how unprecedented levels of wealth can be grown, equitably shared globally for all working class and impoverished people as long as they have access to the internet. Without taking anything away from the already affluent and wealthy, which tends to be the caveat with, socialist policies or ideologies, or also with, policies or ideas such as universal basic income. The question is, where does this money come from? And it's always from corporations, or it's always from businesses, or corporations, or from rich folk. But with cryptocurrency, because of the manner and how it feeds the developers, it feeds the early community members, and then eventually, as the token develops, then it's the general public, then it's the big institutions, then it's the governments, such as El Salvador with Bitcoin currently, for example. So because it happens in that order instead of with stocks, which kind of happens in the opposite order, where when Facebook is pre-IPO is just between Mark Zuckerberg and whoever invested into Facebook early, which is typically big wigs, big angel investors with big bankrolls, not the everyday person like me or you. So that's the reason why I like crypto a lot, is because it's super egalitarian. And on the right, before we move on, you guys can see on the price cycle kind of what I mean by in terms of apex price, birth price, death price. You'll see watch earn is pretty much at our birth price here. We're at sub dollar, where we used to be sub penny. We used to be sub penny and sub 10 cents. Right now we're a little under 10 cents. I think like 8.3 cents, give or take. But yeah, we're at our very beginning, where BNB, in my opinion, is the strongest candidate for the MVP of next crypto bull run, which I've been saying. So you put BNB here, you put Matic there. Then in between BNB and Bitcoin, you probably put Ethereum, and then you have Bitcoin here, where, in my opinion, at least for the medium term, so which is probably the next 5 years, I truly do think that this is kind of like the end for Bitcoin's dominance. I think that Bitcoin is going to fall in terms of market dominance, while other cryptocurrencies, other altcoins kind of take their place. And that's why I think Bitcoin is there at the apex. And then FTT, if you're not aware, FTT is the token for the FTX crypto exchange that just blew up a few months ago. I think it was in November of 2022. And so that's where death price is. And the reason why death price on the model is a little higher than birth price is because with cryptocurrencies, or with most assets, they're never going to go to exactly $0.00. But the reality is that there's essentially, when they're dead, or when there's a huge conspiracy or controversy or something along those lines, and it's pretty much a non-recoverable drop in price, a drop in enthusiasm regarding the assets. So once you have this in mind, and you're going to see this with the other lessons, when you have this model in mind, it's going to be very great for you guys to understand the potential and the risk profiles for associated cryptocurrencies, where the average person, like I said, they jump into Bitcoin swearing up and down that, oh yeah, it's the best, it's the number one, it's lasted for the longest. But it's like, if you're buying at $69,000 expecting it to go to 100,000, 250,000, it's like, well, it just went from 1,000 to 69,000. So it's like, don't you think it should go down? So that's kind of my logic. You would think that's straightforward, but hey, I've had many a debates, Anyway, final slide here, I guess. 1.7 new terms and concepts. So thank you very much for watching this very first video in Watch Earn's crypto fundamental analysis course. Make sure to subscribe, like the video, join our Discord, which is the link for that is going to be in the description box. And if you're able to donate, please do so with Ethereum, BNB, or our own token Watch Earn, which the contact address will be in the description box, to the following address here at the Scan Me little QR code. It would mean a lot to me and allow me to make more of these at a faster pace. So hopefully I'm trying to do at least 3 a month. We just have to see because I have a whole bunch of other videos I like to do, and so I don't want just to get caught up with this, especially since it's just free, so I'm not getting compensated right away. But I will be making more of these. I will finish this 12 hopefully by definitely the end of July. I like to say right now it's the start of March, so that gives me about 4-ish months. So it's not hard to do 4 months for 12 videos. Knock on wood, we'll see. But anyway, lastly, today's terms and concepts were cryptocurrency, white paper, trustless, Bitcoin premium, crypto sectors, fungible tokens, NFTs, color coins, DeFi, DAOs, soul-bound NFTs, KYC AML, decentralized exchanges, bullish, bearish, and those are sentiments related terminologies, price cycle, and central bank digital currencies or CBDCs. Until next time, guys, catch you later. Peace.